We've kind of been persistently in this debasement trade other than maybe 2022. And I think that's going to continue. I do think that Bitcoin, I think that cycle is not done. I do think we're going to see higher prices of Bitcoin in 2026. So that's certainly my base case. I've been focusing on Fiscal now for quite a while. It's played a much larger role than it normally does, especially outside of recessions. We're not accelerating the trade right now. If anything, we're mildly decelerating what is still a very fast trade.
In today's video, Lyn Alden breaks down why the debasement trade is far from over and how Bitcoin and gold are set to remain the biggest winners. She explains how rising fiscal deficits, Treasury issuance, and hidden liquidity flows are quietly fueling another leg of monetary debasement even as the Fed tightens. Lyn also shares her outlook for Bitcoin heading into 2026, why gold's rally may cool short term, and where smart capital is rotating next. Stay tuned. This is Lyn Alden at her sharpest, decoding the future of money in real time.
I think the debasement trade is still in effect. It goes through different seasons. Like I said before, so in kind of the run up to COVID, you had a tightening of the situation. Obviously, the repo spike in late 2019. That was kind of, I would say it was kind of the beginning of the debasement trade as far as I saw it. Then you had, of course, the whole COVID era hyperstimulus. Then 2022, you had a pretty big attempt to pull some of that back. So you got quantitative tightening, you got, fiscally, all the fiscal stuff, a lot of that evaporated. You got this kind of fiscal pullback. 2023 and thereafter, the rising interest expense started to impact the government, and the demographics continue to age. You started to get this kind of rising fiscal situation again. Ongoing debasement trade, even though the balance sheet was no longer a component of that. You had activist Treasury issuance, so we're taking money out of reverse repos, we're putting that back into the system. And so you had this kind of interplay between the Fed and the Treasury for like 3 years, where the Fed was trying to gradually take liquidity out of the system. The Treasury was kind of trying to put it back in, mainly from the reverse repo facility. That was mostly just taking like unused liquidity and sticking it back in, just kind of distributing it back out gradually. And now we're going to be entering a period where we're back into net baseline liquidity happening. Now, even during those 3 years, you still had banks levering up on treasuries. So you had deficit spending fueled by fractional reserve, which means it wasn't like one for one. It wasn't like a private sector entity had to buy a treasury instead of buying a stock. As long as banks were a pretty meaningful buyer of treasuries and doing so on fractional reserve, it wasn't that one for one replacement. So it wasn't as tight as many people thought. So we've kind of been persistently in this debasement trade other than maybe 2022. And I think that's going to continue. Now, I think that where that shows up best fluctuates. So I think that while I'm still long-term bullish on gold, I do think it's somewhat overdone in the near term. If you would have asked me, a couple of years ago, I would have said, yeah, I can see 3,000. I didn't necessarily have 4,000 on my radar, even as a bull. As someone who was long it this whole time, I would not have guessed we'd see, well over 4,000 at one point this quickly. I do think that Bitcoin, I think that cycle is not done. I do think we're going to see higher prices of Bitcoin in 2026. Could be wrong on that, but that's certainly my base case, because I think we'll see somewhat of a rotation there. Somewhat of an exhaustion in the gold market, somewhat of a bid up in the Bitcoin space, especially now that a lot of those treasury vehicle excessive valuations have been, deflated. So that's not really a headwind anymore. Then I think a lot, there still are pockets of equities that are interesting to benefit from the debasement trade. While some stocks are expensive and many markets are kind of at very high levels, I continue to be somewhat bullish on emerging markets. On a select basis. Ironically, think banks are not a bad place to be longer term because they've got high rates of cash and treasuries relative to total assets, so they're pretty buffered from shocks or kind of losses elsewhere. The K-shaped economy makes it so that even as some of their customers suffer, other customers are doing pretty fine. They're getting paid interest on what is probably going to be an increasing base of reserves for them. And so there are pockets, I think, to hide out here. I think the debasement trade continues, just perhaps, not as quickly as it, certainly not as quickly as it did in 2020, 2021, perhaps not as quickly as it did in, say, 2023, but I still think it's elevated. And then it has that aspect to it where it's less cyclical. It's just less of that kind of business cycle up and flow. It's that higher floor we discussed earlier. And that applies not just to economic situation, but it applies to the debasement trade itself.
Lyn Alden nails it here. She's essentially saying the debasement trade never really ended, it just evolved. Despite cycles of tightening and fiscal pullbacks, structural deficits, aging demographics, and Treasury liquidity injections keep a steady floor under asset prices. In plain terms, the system's addicted to fiscal stimulus. Gold may cool off short term, but Bitcoin stands to benefit most as liquidity quietly returns. The higher floor, she mentions, means debasement is now a feature, not a bug, and that's bullish for scarce assets.
I've been focusing on fiscal now for quite a while. It's kind of one of the key things that I think has, in many cases, blindsided a lot of macro, just because in this whole kind of 5 to 6 year period, it's played a much larger role than it normally does, especially outside of recessions, in any sort of like investor's lifetime, for the most part, at least in the United States and many other developed countries. And so it continues to be an environment that is just challenging for a lot of people, myself included, obviously, but being on the right side of fiscal has been helpful. Basically, if we go back kind of earlier this year, my view was that Doge would be ineffective at any sort of like macro scale cuts. But the tariffs were somewhat of a wild card because, well, I don't think they can stop the train. I don't think they can like permanently and kind of sustainably reduce fiscal spending by a huge amount. They can slow the train, and that's largely because one of the key kind of defenses against reducing the deficit is that Congress is very polarized, and emergency powers to use executive orders to do tariffs is basically a unilateral tax increase that bypasses that polarized state. Now, as you pointed out, the Supreme Court is going to weigh in on that likely in November, last I checked. So far, 2 levels of courts have kind of ruled against Trump on that. But those, I mean, I'm not a legal expert. The challenge, of course, is that those were, if you look at the makeup of those courts, they were more Democratic-leaning courts. Supreme Court's obviously more Republican-leaning. But he has put out a number of posts that kind of directly contradict his rationale for emergency use powers. He'll cite domestic issues in Brazil for why they need tariffs, or he'll cite commercial in Canada for why they need tariffs, and that just gives fodder to the other side of that law case. Other than looking at some of the betting markets, I don't have a strong view on how that case is going to go. Of course, before then, we potentially have the ongoing supposed de-escalation in this recent tariff flare-up between the U.S. and China. It's still not fully clear whether that's going to go through or not. In general, that is one of the key speed breaks. And it's showing up, for example, in if you look at ISM PMI, like manufacturing and services PMIs, you'll see that they both have pretty muted activity, but the prices paid segments of those are pretty high. And normally you only get spikes in the prices paid component when you also have a pretty rapid period of expansion. So that combination of lower activity and higher prices paid is this kind of stagflationary effect from tariffs. Now, in context, we're talking annualized a few $100 billion per year, potentially higher if we get more escalation, which would not really be my base case. So that's spread across a pretty large economy, and that eats into something approximating a $2 trillion deficit, which is not immaterial. But it's not like a game changer. So I do think that while Doge was mostly a nothing burger from a macro standpoint, tariffs are more than a nothing burger. They are a kind of one of the top few things that I follow. So we certainly have a lot of news ahead as that goes. So I think that they do slow the train. They just don't stop the train.
So if we just assume for this scenario that we hold tariffs at, say, $400 billion a year annualized onwards, steady state, how do you measure the impact of that on the economy when you pair it with the Big Beautiful Bill and the impacts there? And I'm curious also on that point of measuring fiscal impulse. Critics of the idea of the nothing stops the train would look at government expenditures, the component of GDP, and say, well, look, it's been slowing pretty consistently. Nominal GDP has been just on a steady decline since 2021 when we had those post-COVID booms. So how do you measure that? And what do you think is the impact if we just hold where we're at right now?
Yeah, so I think that the key reason why that's still in play is that if you look at PMIs, you would expect, for example, just looking at them in isolation, if you just say, okay, PMIs are doing this, overall economic activity is slowing to this degree, would stock market be where it is? Would gold have soared as high as it is? Would Bitcoin be 100,000? Would we have kind of had this long of an inverted yield curve without a Ember-defined recession? Basically, the fiscal component is kind of weighing on a lot of that. And I had some discussions or debates with Andy Constant over the past year, and it is true that like we're not accelerating the train right now. If anything, we're mildly decelerating what is still a very fast train, especially in a non-recession environment. These are still very large deficits. And so you have this kind of background stimulatory component that does fluctuate, and that's why I don't just stop writing reports and go to the beach for a year, right? I'm still kind of mapping out the rate of change these things happen, the news events that happens, little booms and busts that happen along the way. So there still are opportunities, there still are uncertainties along the way, but that just kind of underneath this whole sine wave that we normally invest in, there's this higher floor. And so right now, yeah, we're more compressed than we were last year. So basically, we had, of course, the huge COVID stimulus that we had in 2022 was kind of the contraction from all of that, as well as higher prices. 2023 and 2024 were this kind of reaccelerating period in a more mild sense than, of course, the boom. And 2025 has been this decelerating period, but from that high level. And I don't think that will just like persistently decelerate back to what we saw pre-COVID. And then, of course, the other factor is that while nominal GDP is not as explosive as was before, it still is often surprised to the upside, especially compared to a lot of what the bears were expecting. And one of the things I kind of point out with fiscal deficits is that they directly fuel nominal GDP. Of course, they have all the other offsets that can detract from nominal GDP growth. And so when you look at, say, deficits as a percentage of GDP, or even overall federal debt as a percentage of GDP, I don't expect that to grow very rapidly, because I think that both nominal deficits and then to some extent nominal GDP will be generally more elevated than average from what we're used to, say, throughout the 2010s, with the caveat that we still have this, this general like sine wave type activity along the way.
In short, Lyn Alden makes it clear we're living in a world where fiscal dominance and constant liquidity keep the debasement trade alive. Gold might pause, but Bitcoin's long-term setup looks stronger than ever as capital seeks safety in scarcity. If you found this breakdown helpful, hit like, subscribe, and tap the bell so you don't miss future deep dives into Bitcoin, gold, and the evolving global market cycle. See you in the next one.